Welcome to the daily update, where I'll go over the action in the market for Friday, June 7th, and then we'll see how things look for Monday, June 10th. Ended up being a pretty sleepy day. There was this big anticipation and buildup about the employment situation report. It came out, it was stronger than expected. The futures at first went down, quickly recovered. We had a little bit of a lower open. It looked like the market was trying to go higher, but it really ran out of steam quickly, and we saw a pretty slow day. We're still looking positive in the short and intermediate, and especially in the long term, but there's still this weakness that we have to worry about because we're seeing some internal measures that give us warning signs, typically before price action moves, and we just want to pay attention to those and just respect them for what they are. Before I get going, please know that the SPX Investing Program has launched. I'm still rolling things out and kind of building the site as I'm going along. I'm playing around with different ways to do posts and things like that. It seems like every time I do it, it's a little bit different. If you have any feedback about that, please feel free to send me an email. If you're on the website for the program, you can always message me. We can have a chat, what have you. There's a lot of additional information that I go over in the program that I don't include in the videos that I post on YouTube. Here is a link to a YouTube video that just explains the program. There's also a link to get to the SPX Investing Program in the description below this video. Let's go back and talk about what happened. We did have a lower open at S1. Now, the pivot points were really close to each other. That's because Thursday was such an anemic day as far as price movement. So that meant that it didn't take very much to hit either S1 or R1 in Friday's session. We did get to S1 right at the open at 53.38. And prices climbed above the daily pivot at 53.50. That's kind of a significant number and also a psychological level. We got above the unchanged level and slightly above R1 at 53.64. You can see the difference between S1 and R1 is not very great. Then we declined back down to the unchanged level and to the daily pivot. You're going to see this a lot here. Prices climbed back above the unchanged level and got up to R1, but did not reach R2 at 53.77 before declining back down to the unchanged level and to the daily pivot. Prices climbed back slightly positive before closing slightly below the daily pivot. So how many times can I say daily pivot in one setting here? We were down 0.11% on below average volume. It seemed like there was this huge buildup, and then it just turned into a nothing burger. We are positive in the short, intermediate, and long term, but we need to keep our eye on some things that are fairly critical. It's about inflation and interest rates and what's the Fed going to do. And we're going to get some big reports in the upcoming week. We have CPI and PPI coming out this coming week, and that's going to really have an influence. Of course, we thought the employment situation report would have an influence as well. And then we just want to be aware of all the crazy stuff going on in the world. Some comments, the employment situation report was pretty much a non-event. There was the initial reaction, and then we had a little bit of a lower open, but then it's like, okay, is this it? I thought the party was going to last a little longer. Now, on a positive side, though, you can say, well, we didn't see an awful lot of selling into strength. So, and there's a chart later on that I'm going to show you where there's this fear of missing out, not really to the upside. And I'll show you that here in just a moment. What really put a cap on stocks in Friday's session was interest rates really spiked back up and the dollar was strong. So that really limited what stocks were able to do. On a short-term basis, we have the stochastics, the Williams percent R, CCI 14 and 20. In the intermediate term, we just have the Sean trend meter. The scenario, if you've been watching these videos, I haven't changed it for a few days. The Fed is keeping rates higher for longer. We already know that. We've been experiencing that. If there's going to be a rate cut, it looks like it could be in September, and I'll be going over that in the weekly video as I look at the probability charts. And then there's been this concern coming back into the market about economic growth. And this is starting to worry the market. Well, we should have really gone up if this worry means that good news is good news and bad news is bad news, because the employment situation report was actually pretty strong, except for the unemployment number itself. It came in at 4%, but the market just didn't have enough juice to do that. In Friday's session, the dollar was up and interest rates were up. We were at 4.28% after Thursday. We jumped all the way up to 4.43% in Friday's session. It's a wonder stocks didn't even go down more because of interest rates. We're still inverted with the yield curve. Sentiment is neutral. It was unchanged at 45. We're still not trending. So if you do sideways strategies, and I've been showing some of those in the videos that I do in the SPX Investing Program, you love these days because you're selling things that every day that goes by, it's like tick, tick, tick. It's getting worth less and less, which means that you can buy it back at a lower price later on. So these kinds of days don't really bother you if you implement that kind of a strategy. But for right now, we are positive. The green line is on top of the ADX, but the ADX is weakening. It's still below 20, and it's still below its moving average. Because we've had a couple of down days, I changed it to mixed for the bias, but we're still pretty much, excuse me, we're still pretty much positive with the momentum. Economic reports. This was the big employment situation report. Non-farm payrolls, much stronger than expected at 272,000. This is making it look like the Fed's not going to cut rates in September, possibly not even in 2024. We don't know that for sure yet. They had expected 185,000. And I'm keeping an eye on the previous number because it often becomes, it's revised. And we initially heard it as 178,000. They revised it down to 165,000. Non-farm private payrolls also greater than expected at 229,000. They expected 168,000. This was also revised down from 167,000 last time to 158,000. The average hourly earnings were a little bit more than expected. Market could have freaked out on this. That's slightly inflationary. It came in up 0.4%. They expected it to come in up 0.3%. Last time it was up 0.2%. So we saw double the growth in earnings. The employment rate, they expected it to come in at 3.9%, which is what we saw last time. It came in at 4%. And as I mentioned from time to time, the markets, this is a headline number that the markets really don't pay attention to. It's a round number. The financial media will report on it. Politicians deal with it, either positive or negative. You can say, oh, the unemployment rate's climbed up to 4%. If you think that's bad, you can say, well, the unemployment rate's only at 4%, if you want to spin it and try to make it look good. The average work week was unchanged at 34.3. My goodness, to only have a 34.3 hour work week. That would be interesting. And it's what they expected, and it's also the same as what we saw last time. Wholesale inventory is not a major thing here. It was up 0.1%. They expected it to be up 0.2%. Last time it was down 0.5%. So here's some charts. Here are the hourly earnings. I don't show the charts of the jobs because the skew is so great when you go back to the COVID crash. The chart's pretty much useless. But this is on a year-over-year basis where it is starting to turn back up. This could be somewhat inflationary. Here is the change just going from month to month here, where we did see a real spike up in the payroll change. Here's the unemployment rate now coming in at 4%. So when we combine that with what we received on Thursday, this chart is now updated where we show the initial claims in red, the continuing claims in blue, and the unemployment rate in black. And here's a little easier chart to see here where we are seeing this coming up slightly. And then some blog charts. This is a similar chart to what I showed for Friday's video. It says real S&P 500% deviation from exponential growth trend. Real just means it takes inflation into account. And this is just showing how things are really going up. and we're deviating because the zero line, this is like a detrended chart. So whenever we go above zero, we're deviating above. When we go below, we're deviating below. And it just means we're getting kind of far away from this zero area. The Magnificent Seven stocks, the market cap is now bigger than the second to fifth largest countries within the world. Okay, just an informational chart here. Just to people like these things and to compare it. And then this is money market fund assets. It did decline just a little bit, but there's an awful lot of money. And this came about because folks could take their money out of the banks where they were getting almost no interest on that. They could put it into money markets, which are getting better interest. Now, some people think this is just fuel on the sidelines that can go into the stock market, and that's true to a degree. But a lot of people putting it in a money market, that's as far as they want to take it. They just want a better return on things. And this is kind of a convoluted chart. This is buybacks have added 1 percentage point per year of earnings per share over the past decade. This is trying to measure the buybacks that and what that has an influence on, where it can have an impact on their PE rate or PE ratio. This is the net buyback here, the earnings growth, and then the dividend return. And over here is what we're looking at right now. So it's seeing more of a change in the earnings per share and the PE ratio as well. Then the U.S. remains the world. Okay, didn't I already show this? It's still the #1 currency in the world here. And then some interesting charts on Twitter. The dollar had a strong day. I usually don't show the dollar with any studies on here in the daily video. I do a little bit more on the intermarket analysis video and the weekly video. But it had been going down, and that was giving support to stocks. And then it really shot up in Friday's session. That could have limited stocks' upward potential. And then this is what I was talking about with FOMO, the fear of missing out. This is when we're seeing most of the panic or the craze that's going on, especially with the NASDAQ 100. It's not when it's going down that people are freaking out. It's when it's going up that people are freaking out because they're afraid they're going to get left behind. They're not going to be able to buy the Qs or NVIDIA or any of the Magnificent Seven stocks. And so we're seeing a lot more of this volatility on up days. Now, this isn't measured by the VIX or even the Vixen, which measures the NASDAQ 100, but this is when we're seeing a lot more enthusiasm in the market, but we just didn't see that in Friday's session. This is a scary chart to me, and I usually avoid these charts, but this is historical. This goes all the way back to the 1300s. And the takeaway from this is this line that you see going down here. This is the gradual decrease in interest rates over time. And then different historical events like Simon Van Halen. Apparently, this is the Van Halen relative we never heard about from the 1300s. No wonder all that talent was passed on into that family. What I get from this is if we look over to more current times, we're starting to shift back more above this line as interest rates have been going back up. And that might be what we see. You can see 1959, they did dip down here for a while. Then they were starting to go back up. We might be getting into a higher interest rate environment. And I talk about that in the weekly video, which doesn't seem normal unless you've been in this for a very long time. The last 40 years have actually been it's been the exception, not the norm. But for a lot of money managers, a lot of investors, they've never seen anything but a declining interest rate environment. Now, something happens economically, a black swan event happens, and interest rates have to be lowered again. Yeah, that's always possible. All we can look at now are the general trends over time. Then this, if you trade options, and a lot of the strategies that I teach evolve around options, you like this chart. You like that there is massive growth in volume when you're measuring the contracts that are actually traded. This does us a lot of good. That just means there's more participants. The bid-ask prices tend to be closer to each other. You can get in and you can get out quickly, even if you do slightly more complicated strategies. So I see this and it's very encouraging because I started back here in the mid 90s or so, and I might go hours just trying to buy a call or a put just because there wasn't a lot of liquidity at that time. That was another reason for switching from individual stocks over to the S&P 500, which I started off with mutual funds there, and then I eventually switched over to ETFs once they proved themselves because the SPY was the first ETF. It came out in 1993. I wanted to give it some time first. But even the options on those, they weren't all that liquid. You couldn't get in or get out quickly. And this is a major factor as far as I'm concerned. All right, let's go back and look at the intraday chart here. We did have a little bit of a lower open. We started at S1. We went right up to the unchanged level. It looked like, okay, here we go. We're going to break out. We're going above R1. Well, we fell back. Then we tried to give it another chance. Didn't quite get up to R2, and then we fell back. And then we tried to bounce up a little bit, and then we fell back. So then we ended up closing slightly lower on the day. Here's our intraday chart. Nothing really all that massive here. This is where we saw the real dip. This is right after the employment situation report came out, and everything did shoot down negative. But see how we clawed our way back and really didn't hit that low again. Here's our intraday chart. This is positive. We're still seeing the blue line above the red line on an intraday basis as growth is outperforming value. Saw a little bit of a tick up here with S&P growth to value. Our end of day chart, growth was down, value was down, but growth was down less. So that means it actually outperformed, where it was down less for the mid caps, but down more for the small caps. So looking at our different ratios here from growth to value, we ticked down with the small caps, ticked up a little bit with the mid caps, and actually ticked down slightly with the S&P growth to value ratio. We're still looking okay here. When we look at these two ETFs compared to each other, we're still coming up. We're actually up slightly in Friday's session with this ratio. But discretionary, not really doing all that well. It's chopping sideways. Where discretionary is getting any strength from, it's from weakness that we've been seeing with the staples lately. Large cap growth down slightly, but just coming off of a recent all-time high. The Wilshire was also down 0.21%, bounced off the 50-day moving average, also coming off of a recent all-time high. Our trend shows that we're still not trending. We're still below the moving average. It's trying to turn back up, but it hasn't crossed yet. The green line is still on top, so we default to positive. We're seeing pretty much that same thing in the short term, but we are seeing a bit of a turn up with the ADX, but it hasn't quite crossed above its moving average yet. Volume is continuing to drop off. Looking at sentiment, not a real big change with the Ulcer Index. This reading came out a few days ago at 3.16, showing that the Investors Intelligence survey shows that most folks are bullish on the market right now. We did see a decline on a closing basis with the VIX. We also closed near the bottom with the VIX when we look at the bar chart. Volatility of the VIX, the bar was a little bit wider, but we ended up closing slightly lower there. And the momentum could be getting ready to shift back here. The MACD is still showing that the momentum for the VIX is up, but with these down moves that we've been seeing, the MACD is picking that up, and it might be crossing over negative here soon, which would be positive for stocks. Equity put call ratio continues to decline on the daily chart. We're also continuing to decline on the 5-day chart, and that's positive for stocks. The volatility risk premium did decline. We're still at the upper end of this band. We ticked up with this fear gauge, but our other fear gauge showed a slight decline. Our advanced decline line studies, we're just seeing a bit of a trailing off here. Now what is appearing is a slight divergence, actually a negative divergence. Where we set an all-time high with the S&P, we have not matched that yet based on price. We're getting a little closer based on volume, and volume is still continuing to outperform price. So there's a negative aspect in the negative divergence based on price, but a positive aspect when we look at this based on volume. We are still seeing a bit of an improvement here. The new highs did contract. We're not seeing an expansion of the new lows. So our 5 period is just starting to turn back up. The 10 period is still declining, but starting to slow down in its decline. We're looking positive and negative here. The blue line is below zero, that's short term, where the red line is still above zero, that's positive, and with the intermediate term. We're turning down just a little bit with accumulation distribution, but this is still positive. It could be that we're getting kind of far away from the moving average. And I wish there was a way I could measure this. I've tried to set this up and I'm just not able to do it through stockcharts.com. I would like to measure the distance from the indicator to the moving average. Simple, very similar to the boom indicator, but maybe I need to spend more time doing that, but I just haven't found that yet. So for right now, I just look at it. And the chicken money flow, still positive, but now we're seeing this showing a bit of weakness. And the chicken oscillator, after getting up above this red line, looking somewhat extreme positive, it turned down back below the red line. We saw a decline with the cumulative NYSE advanced decline line, also a decline with our regular NYSE advanced decline line. This other NYSE advanced decline line also declined, but not much of a move here. And when we look at this, volume is still looking a little bit better. When we look at common stock for the NYSE based on price, we saw more of a decline. We saw less of a decline here based on volume. And we've been seeing that the last few days. But be aware of this, because I tried to point this out in the past and it ended up leading to nothing. Right now, it's just an observation, just something we want to be aware of. We declined with the S&P cumulative based on price. We actually went up a little bit based on volume. We're seeing a little bit more weakness here. We're right down to the moving average with NYSE common stock. We did decline, but we're still above the moving average with the S&P. We're dropping below the moving average with the mid caps and the small caps. Here's our daily chart. Really nothing new to show in this because we saw such an anemic move as far as price, but volume really dropped off. The wins percent did decline, but it's still extreme positive. The CCI 14 is extreme, and the CCI 20 is also still extreme. The short-term stochastics did decline, but it's still extreme positive. We're looking positive and getting extreme in the intermediate term. We never did drop out of being extreme positive with the long-term stochastic, and now it's going back up. We're still hanging out right about on these lines. When we look at the double and triple exponential moving average based on 20 periods, we decline with the 20, a little bit with the 50, and we're also slightly declining with the 200 period moving average steady. The force index did decline, but it's still positive. We're still above the 20 period moving averages. We're still in the +2 channel with our standard deviations chart. Balance of power right back to zero again. That's really showing that there's no edge according to this chart. We're still positive with the go, no go with the darker blue bars. We're still up at the blue line, and the blue line is turning back up with our highest high value chart. The TTM squeeze is still darker blue, still declining. It looked like it was slowing down, and it could still slow down, but it's still declining nonetheless. We're still above the 50 period double and triple exponential moving averages. So this is still holding up more in the intermediate term. We're also still above the 50-day moving averages when we look at them, the regular measures that most people use. The ease of movement is still above zero and advancing. That's positive. The Arun continues to be positive, and it goes up a little bit more, and you might make a case for it being extreme positive. This is where we start to see some weakness signs. The S&P McClellan oscillator declined, and it's still below zero. That is negative. Here's another weak area that we're seeing. The summation index based on price and volume continue to decline. We're also negative on a broader market measure with the NYSE McClellan oscillator below zero and declining. So the summation index for the NYSE is declining based on price and volume. And this had been looking a little more positive. Now it's switching back and looking more negative. The Swenlin trading oscillator based on price, now it's dropped below the midpoint. That's turned negative. We have turned down based on volume, but we're still above zero. So we're getting a mixed picture with this indicator. The momentum's trying to turn back up. The PMO is showing a little bit of an improvement, but based on price and volume, we continue to decline. We're a little bit weaker with the PMOs that are rising. We're still going up with the buy signals, but we're declining with the PMOs above zero. And we continue to be positive with the Elder's Impulse system for the S&P. We're still positive with the parabolic SAR. The slope oscillator is still negative since it's below its moving average, but it's trying to turn back up. The MACD is actually getting a little bit back above its moving average. So when we break this down, short term still looking weak with the slope. The TSI is actually looking a little more positive. Then we have our three intermediate term oscillators. The MACD crossing back above its moving average. The PMO trying to go back above its moving average. The PPO right on top of its moving average. And when we look at our longer term oscillators, the TRIX and KST, we're right on top of the moving averages with both. We're still above all the plotted moving averages here. And we're still looking okay, even though we declined just a little bit with the bullish percent index. We're still above 50. We did see a nice little bounce up, but then it was down in Friday's session. This is a primary indicator. We declined just a little bit with the NYSE bullish percent index, but still above 50. This is another warning sign. We did go up with the NASDAQ 100 bullish percent index, but we're still below 50. It's still negative. The money flow continues to be positive. The ultimate oscillator is positive. The vortex continues to be positive with the green line on top. And the RSI based on 14 periods, we're spending most of the time now since the beginning of May up above 50, and that's showing good momentum. We're seeing a similar thing here with the RSI 9. This is a little more radical in how it moves, but it's also been above 50 for the most part, except for that dip that we saw back in April. On balance volume, since we had the slight down day, that means according to this indicator, all of the volume counts as negative, but we're still above an advancing moving average. And when we look at the stocks above their 20-period moving averages in the S&P, we're continuing to decline and we're below 50. We're not really seeing much of an improvement here with our 20-period moving average study. We're also below 50 with the stocks above their 50-day moving average. So short and intermediate term, we're not seeing an awful lot of strength right now. We decline, but we're still above 50 with the 100-period moving average study, and we continue to decline with the stocks above their 200-day moving average. So these are some of the weaknesses when you take them together. The Copic curve is still negative. The Sean trend meter did tick down, but it's still barely extreme positive. Don't have any support or resistance levels because we really haven't moved lately. The Heiken Ashi is continuing to be positive. So on a trending basis, we're still looking pretty good. And we see that with the Kegi chart, also still positive. The Renko chart is still going up, and the three-line break is also going up. Long term, we're no longer extreme with the 150, and the 200 finally dropped down below the red line. So that's just showing that the momentum that we had been seeing is seeing a little bit of weakness, but it hasn't turned negative. It does look like we started a new 50-day cycle on June 4th. We'll just have to see if that leads to anything now. And we, excuse me, having to clear my throat quite a bit. We have not received a confirmation signal with the Hindenburg-Ullman indicator. People are just waiting for this, especially the perma bears. If we see another spike up, you can see other times when we had confirming signals, this typically meant something bad was happening. But we saw one in February that was not confirmed. We have to let this play out through the month of June to see if we get a confirmation signal. Our different indexes, the mid caps and small caps, are negative in the short term. Everything else is positive. Where bonds are positive in the short term, but negative in the intermediate and long term. We're still negative in the short term with commodities. And the dollar was really up on Friday, but it's still in a downtrend in the short and intermediate term. No changes with the decision point scorecard. We saw a negative thing right off the bat when the NASDAQ broke below 17.1, but then the Dow got back above 39,000. The S&P set a new all-time high. Now, that's intraday. We didn't close at that level because we were down, but we did set an intraday all-time high, and then the NASDAQ got back above 17.2. As far as the different sectors, the financial sector did the best, followed by tech and healthcare. So we're seeing a real mix here. The other sectors ended up being down, with utilities being down the most. I wanted to show this because we're just barely starting to turn negative. When we look at the NYSE new highs minus the new lows, I plot a 50-period moving average. Now that's still positive, but the raw score from day to day has now dropped below zero. And we saw that recently Then we went back positive and I stopped showing this chart. Now we're looking back a little bit more negative currently, where the equal weight really underperformed. We can see that here with the ratio. That means that the mega caps, even though they didn't have a great day, they did outperform the rest of the S&P 500. The Dow is really having some problems here. It's right up at this pivot point and right about at its 50-day moving average, not really breaking out after it had been bouncing up a bit. We've gone from being positive to neutral with the Elder's Impulse system for the diamonds. Saw a little bit of a downtick again with the NASDAQ, as well as a downtick with the NASDAQ 100. We still are positive with the QQQs when looking at the Elder's Impulse system. The momentum for the NASDAQ 100 is continuing to turn back positive. Small caps, of course, they had the decline and they've gone down below their 50-day moving average. And I say this in kind of a sarcastic way. I don't participate in the small caps, but I know a lot of people that watch these videos do, and it must be really frustrating for what you have gone through, unless you can just go with these ranges here. And we continue to be negative with the Elder's Impulse system for the small caps. We dropped below the 50-day moving average with the Russell 2000. We're falling further below with the RSI. The momentum continues to be negative, but the long-term trend is still positive. Also, the mid caps are not showing an awful lot of strength right now. They're having a real difficult time getting above their 50-day moving average. And they've gone from being neutral to negative with the Elder's Impulse system for the mid caps. Apple was up 1.23%. Again, we could be getting ready to see a golden cross here. Tesla, which is in a downtrend, was down 0.25%. Nvidia saw some slight profit taking, but closed down barely compared to how it usually moves. Microsoft was down just a little bit, but still above its 50-day moving average. Meta also still above its 50-day moving average. Amazon down slightly. And Google was down 1.31%, but still looking pretty solid. Netflix was down over 1%, also still looking okay for the time being. The FANG index, coming off of setting a recent all-time high, was down 0.24%. The financial sector still dancing around its 50-day moving average, but the longer-term trend is still intact. We did go down a little bit with our staples to tech ratio, but we've been just chopping lately. We want to see this ratio continue to go down to remain more positive. The dollar was up pretty strong in Friday's session, and it's still in a longer-term uptrend here. And then when we look at the S&P and compared to the world index, seeing a little bit of a tick up in the short-term correlation. The longer-term correlation is remaining steady. The staples sector was down almost 0.5%. So we saw a little bit of profit taking there. Utilities were down over 1%, but still looking positive. Healthcare was actually up a little bit, and it's really been roaring back. This is one of the defensive areas that we're keeping an eye on. Energy was down 0.4% and still below its 50-day moving average, but still in a longer-term uptrend. The total U.S. stock ETF was down 0.2 after setting a recent all-time high. We really shot up with the 10-year yield here. That kind of spooked the stock market, and we really came down with the 10-year based on price. Looking at our growth to value ratios, still above the moving average when we look at the Qs to S&P. Discretionary turned up, but still below a declining moving average. We're seeing a little bit of an improvement here when we compare large cap growth to large cap value. So the large caps are looking better, but we're not really seeing anything with the mid caps, and we turned down, but we're slightly above the moving average with the small caps. I was pointing this out as looking slightly positive. Well, now the 19-day exponential moving average of the advanced decline ratio, we've dropped below zero again based on price, but that's the negative part. On a positive side, we're still above zero based on volume. The S&P to utilities ratio is starting to tick back up. It's not so much strength in the S&P, it's some weakness that we're seeing right now in the utilities. And same thing here with the staples to S&P ratio. It did go down, but we want to see this go down as the S&P is going up, not because staples are going down. So what's our outlook for Monday? I haven't changed anything here because there's really not much to change. We're still positive when you take everything together. And strength has been re-entering the market. But there are these weak areas that we need to pay attention to just to keep an eye on them. We still have positive seasonality for Monday. We're not going to have any economic reports. And then we want to keep an eye on the geopolitical events. Here is the economic calendar for the upcoming week. Nothing on Monday. We're going to get CPI on Wednesday, and then the Fed's going to come out. So that's going to be a pretty monster day as far as information. We're going to get PPI on Thursday, and then we'll get consumer sentiment on Friday. Here's the upcoming calendar, and what they're showing is the previous readings and what the forecasts are. Seasonality, we're positive with the Dow and S&P, or we're neutral to positive with the S&P for June 10th. Monday is the most positive day of the week. We'll see if we see some follow through there. We still have, according to this, one more day of positive seasonality before we go into a period of weak seasonality during an election year for the S&P. Here's a newer chart. June, July, and August are historically the best 3 months of an election year. Okay, let's prove it to us. We're not really seeing much of it yet. And then you also want to keep an eye on July and August, even though their returns are less, but they're still positive. Now we're coming into the period of time, according to Tom Ballard's research, where we could hit some bumpy weather. So the warning signs, we're still keeping in the back of our mind that when the S&P made an all-time high, staples and utilities were strong, and that's usually a defensive sign. We're also watching energy and healthcare. The growth to value and discretionary to staples ratios, they're not leading things higher anymore, or at least currently, and haven't been for a few days. The McClellan oscillators for the S&P and NYSE, as well as the summation indexes, are negative. The Swenlin trading oscillator is turning negative. It's negative based on price, but it's holding up better based on volume. And our oscillators are negative, but showing signs of an improvement across the board there. The Kopit curve is negative. Our 20 and 50 moving average studies are negative. And the bullish percent index for the NASDAQ 100, even though it was up, is still below 50, so that counts as negative. The positive signs, we're still going down with the 5-day equity put call ratio. The advanced decline lines, when you look at the common stock and the S&P, we're still above the moving averages. We're starting to drop below with the mid caps and small caps. Then we have our positive things, and I think I changed things the right way here. The parabolic SAR, which is a primary indicator, is positive. The bullish percent index is above 50. It's still bouncing a little bit, even though it was slightly down in Friday's session. Then we have accumulation distribution, Chaikin money flow, and the Chaikin oscillator. Yeah, here you go. But they're not as strong as they were, but they're still positive. And I tend to treat all three of these together as one unit. The money flow and the ultimate oscillator are positive. The vortex is positive, and the financial sector is positive. And the momentum for the NASDAQ 100 is still crossing back over positive. So our conclusion, same thing that I've been saying. There's really not much to change here. We are positive. Strength is re-entering the market, but there are those areas of weakness. We still have Monday's session for positive seasonality. That's what we're saying in the short term. We're also seeing an improvement, and we're positive in the intermediate term, but we want to keep an eye on those areas of weakness. We're still positive in the long term, even though we're seeing the 200 period moving average not as extreme positive as it had been. Thank you. I really hope you found this helpful. I will be putting out the weekly videos over the weekend. I hope you do have a very nice weekend, and I will talk to you in the next video.